It's Brian Preston, the money guy.
Jennifer has a question. She says, why is someone trying to sell me a TFRA? I think she means tax-free retirement account. And what is the benefit to this?
Did she call it a tax-free retirement account? Because
that is what Daniel and I think she means. I will be fully honest.
Look, I'm gonna go benefit of the doubt here, right? We love tax-free retirement accounts.
And we love Roth tax-free.
See, why are you gonna steal my thunder? Could you not see the build-up
he
I
was
was doing
about to
here?
just set that
I had
up.
an entire narrative.
Keep
I was
going.
gonna
Keep
do a
going.
thing.
I'm sorry. Preach.
You know what?
I'm sorry.
Why'd you do that? Tax-free retirement accounts, we love them. We love them so much, we make them step 5 of our financial order of operations, Roth IRAs. It is truly a tax-free retirement account. And then if you include health savings accounts, those are also tax-free and they can be used in retirement. So we love those. Now here's the great news.
There was a catch there though.
Nobody has to sell you. Were you about to say that?
I was about to say, she used the word somebody's trying to sell me. Most people, Vanguard's not out there going, Fidelity Investments is not out there going, hey, we have these Roth IRAs. They're going hot. We better get in here quick.
That's exactly right. So a tax-free retirement account that you can go open for yourself is a Roth IRA, or go open up a health savings account. And those are wonderful. And you don't have to have someone sell them to you. You don't have to pay a commission for that. What she's probably talking about, I'm guessing, is some sort of insurance product or some sort of tax-free annuity where you can build up assets in that and you can borrow money at some future point and it's going to be technically tax-free to do that. That is an entirely different thing, and I would not actually call that a true tax-free retirement account.
Yeah, because the only way it's tax-free is if you basically die with it.
Yep.
Because otherwise you might be getting married to this insurance product for the rest of your life. Because think about the fact to do what they always share in these tax-free insurance products is you overpay for insurance while you're young and healthy, so this cash value can build up in the background. And then where the tax-free comes in is you can take exactly what Bo said. You can take a loan from that cash value. But the problem is, now that once you take that loan from the cash value, what happens if you get to be late 70s, early 80s, you have a huge loan, and the cost of insurance is still building in the background because you're older. You know, unfortunately, we're all going to die at some point, so the cost of insurance knows inevitably that this policy will pay out. Well, what if you burn too much of the cash value? Now the policy kind of implodes and you create a big tax liability. It's no longer a tax-free thing. I don't like that. I'm trying to build financial independence, and financial independence to me means you have no encumbrances, nobody who can tell you what, when, and where you have to be at any point in time. And that's by the way, what do you think the insurance company, if you're overpaying for this insurance in your 20s to build cash value, what's the insurance company doing with that money? They're investing it. So why not take out all the middle people that are in the middle, going out there, taking this, paying commissions, because usually those insurance commissions, there's a reason they can afford to have the sales force. Why not you do that? Just do what the insurance company's going to do. If you need insurance, go buy term life insurance, but then go and invest in these true tax-free growth opportunities like Roth IRAs, Roth 401ks, health savings accounts. You don't need an insurance agent to make that stuff happen.
Here's your litmus test to protect yourself against the insurance agent. Go download our free deliverable. Go to moneyguide.com/resources. Download the free deliverable. Brian, hold it up. You should not even be thinking about these types of products until you've worked through, until you've done your Roth, you've done your HSA, till you've maxed out your other retirement available options in your 401k and 403b. And it's only at that time, when you get to step 7 of the financial order of operations, would you even almost theoretically think about utilizing a product like this. And then you got to lay it side by side and say, does this product make sense for me, or does just a regular taxable after-tax brokerage account make sense for me? What are the costs? What are the fees? What's the incentive for the person sitting on the other side of the table for me? And what's ultimately going to be in my best interest for the goals that I want to achieve? And I find that most people, when you work through that process, at some point in there, you will disqualify this insurance or annuity product because it likely does not make sense for you.
Well, and go download also moneyguy.com/resources, the 8 questions to ask a financial advisor, because insurance agents fall into that category too. And if they tell you, when you say, how do you get paid? They're like, oh, you don't pay me anything. The insurance company pays me this. And be like, wait a minute. No. I'm still paying you. Even though the check's coming from the insurance company, it's through the premiums, probably close to 100% of that first year premium is going to the insurance agent. Just ask those questions. Why not? Just be transparent, find out what's going on. I think that will help you make the better decision.
Love it.